U.S. bank stocks are solidly higher after a bank earnings season kicked off with results that beat estimates generally. We're looking at JP Morgan, Goldman Sachs, and Wells Fargo with some solid gains. Bank of New York Mellon also joined the fun. To break it down for us, let's bring in Gerard Cassidy, Managing Director and Head of U.S. Bank Equity Strategy for RBC Capital Markets. Hi, Gerard. Thanks for being with us.
You're very welcome, Mark. Thank you.
I know you were inundated today, tons of earnings reports, lots to go through, but what's your overall impression so far?
So far, the results for the fourth quarter have been better than expected. All of the big banks, we've had 5 large banks report today, as you pointed out, and all of them have beat expectations on the bottom line. And more importantly, when you look at how they beat the expectations, it was across the board net interest income, which is the backbone of revenue growth for all the banks, even the large money center banks, came in better than expected due to better than expected net interest margins. We'd also point out that the banks that have big investment banking operations like JP Morgan, Goldman, and Citigroup also came in with strong trading results as well as investment banking results. And I expect that when we go look forward, the investment banking activity should remain robust with this outlook we have for the U.S. economy and the impact of the incoming new Trump administration.
Gerard, you have an outperform on JP Morgan. You were just touching on it there. Record revenue in the year compared to 23, and then record trading revenue as well. A previous guest said that this is the best risk-reward company, not just in financials, but maybe across the entire U.S. spectrum. Is that going a bit far, or do you like it that much as well?
I would say that J.P. Morgan has done an excellent job in running their bank, particularly led by Jamie Dimon. And the valuation right now is very high. Deservedly so. It's a very profitable organization. This quarter, their return on tangible common equity was around 21%. And I think what you've seen is that the company has delivered for years. And so it is certainly a backbone for many long onlys. That being said, though, there's better opportunities, I think, to own similar types of companies with more upside, companies like a Bank America or even one of the regional banks like U.S. Bancorp. We think it will give you that upside, and there's really not that much risk with the outlook we have for the U.S. economy and the outlook for credit quality.
And then with Goldman Sachs, it seems to be a company that is always adaptable, changing with the trends, and it just knows how to make money. So what did you think of Goldman's numbers?
You said it well. They are very adaptable. They're an incredibly strong company, incredible presence in the capital markets, a very strong brand. One of the leading M&A advisor out there. So they put up very strong numbers. And as you might recall, they had a strategy change about 4 or 5 years ago, moving into consumer banking, which proved out to be a bad decision. They've exited almost all of those businesses, and they're going to focus now on trading and investment banking and wealth and asset management, which is their expertise. And we think going forward, if the capital markets continue to be robust and we see a strong investment banking outlook that brings along with it acquisition financing, Goldman's going to see some very good revenues in 2025.
As far as Citigroup, you have an outperform on that. You say the numbers were pretty strong. Would you agree, though, that this can be sort of a polarizing stock for certain people? We had a guest earlier say today that he doesn't think that Citi will ever get back to that heyday of being a real premier Wall Street firm. And if you look at a one-year chart here, you'd probably have to disagree with that. But where do you stand on Citi? I mean, clearly you like it with an outperform, but do you understand some of those concerns?
Oh, absolutely, Mark. And I think they're very well said or well identified. When you think back to the way where Citi traded back in 1999, 2000, before that meltdown in the economy, I doubt they'll ever get back to those heydays. However, that being said, where the stock trades today relative to book value and tangible book value, there are still ways of really making good money owning Citigroup. And one of the ways is that the company announced today, as part of their results, a $20 billion share repurchase program. And so I think what you're going to see is, with their stock trading below book and below tangible book value, the best way to accrete or to grow tangible book value per share is to buy back their stock, and that's what they're going to do. So I wouldn't expect them to ever, get back to the heyday of where they once were, but they don't need to for investors to make good money on the tactical trade of owning this company as it divests and continues to divest businesses that are not important to their long-term future, and at the same time, they aggressively manage their capital levels.
Now, the bank stocks that you've been talking about, they tend to steal the headlines. We probably don't talk enough about the likes of Bank of New York Mellon. What were their numbers like, and how do you compare that bank to some of the others?
No, it's a good point, because Bank of New York Mellon is like State Street, and similar also to Northern Trust, what we refer to as our custody banks. Now, of course, Citigroup and JP Morgan are in the same security services businesses as those three, but is more dominant, obviously, with Bank of New York and State Street. And so when you look at a Bank of New York, they're not necessarily a lender like a JP Morgan. They don't have a credit card portfolio. They're not making leverage loans. And so when you look at Bank of New York, it's more of a fee-driven revenue model, as we like to refer to it. But net interest income is still important. For a typical bank, net interest income runs anywhere from 60 to 70% of total revenues. In a fee-based bank like a Bank of New York, that number is closer to 15%. So it's all about the fees. And Bank of New York is one of the leading custody banks in the world. It also is a very large asset manager. And those numbers came in very nice and strong today. And more importantly, Bank of New York has delivered on expense control. And this has led to what we call positive operating leverage, where revenue growth exceeds expense growth. Bank of New York has not done a very good job there, but under the new leadership of their current CEO, what you're seeing is that he is delivering. He's there about a year and a half now, and he's starting to deliver, and it's showing up in the stock price as well.